The Federal Reserve has taken many unprecedented steps in the past 4 years to try to boost the U.S. economy and counter the effects of a financial crisis that triggered a painful recession. It has kept the short-term interest rate it controls at a record low near zero since December 2008. It's bought more than $2 trillion in U.S. Treasuries and mortgage bonds to try to hold down longer-term rates. Those purchases have increased the Fed's balance sheet to more than $2.8 trillion. Some steps the Federal has taken. November 25, 2008, the Federal says it will buy $500 billion in mortgage bonds. December 15 to 16, 2008, the Federal creates a target range for interest rates and cuts its key federal funds rate to between 0 and 0.25%. That's a record low. The Federal vows to use all the tools it has to rescue the economy from the worst financial crisis and recession since the 1930s. January 27-28, 2009, the central bank signals it's prepared to buy longer-term treasuries and expand other programs. March 17 to 18, 2009, the Federal says it will start buying up to $300 billion in government bonds over 6 months. It also decides to boost purchases of Fannie Mae and Freddie Mac mortgage-backed securities and debt. The actions are aimed at driving down rates on mortgages and other debt. September 22 to 23, 2009, the Federal slows a mortgage buying program to complete its purchases by March 31, 2010, instead of at the end of 2009. August 10, 2010, it decides to use some money generated by its mortgage portfolio to buy government debt, to try to lower rates on mortgages and other loans. August 27, 2010, in a speech in Jackson Hole, Wyoming, Chairman Ben Bernanke lists several options to boost the economy, including the purchase of additional government bonds. OCT 15, 2010, Bernanke signals the Federal will buy more government bonds to boost the economy, drive down unemployment and protect against deflation. November 3, 2010, the Federal announces it will buy $600 billion more in Treasury bonds to try to hold down longer-term rates. June 22, 2011, the Federal confirms it will complete its purchases of $600 billion in Treasury bonds by the end of the month. The purchases were intended to drive down rates on mortgages and other debt. August 9, 2011, it says it plans to keep its benchmark short-term rate at nearly zero until mid-2013. It's the first time the Federal has set a target for keeping the rate at that level for a specific period. The date reflects its assessment that the economy will remain weak. September 21, 2011, through a program called Operation Twist, the Federal says it will sell $400 billion of its shorter-term securities to buy longer-term holdings to try to lower Treasury yields further. The Federal also says it will reinvest its holdings of mortgage-backed securities, which could help keep mortgage rates at super low levels. January 25, 2012, the Federal says it's unlikely to raise interest rates until late 2014 at the earliest, extending the period of record low rates by at least a year and a half. June 28, 2012, the central bank says it's extending Operation Twist through the end of 2012. And it says it's prepared to act further if the economy deteriorates. September 13, 2012, the Federal says it will spend $40 billion a month to buy mortgage bonds for as long as it deems necessary to make home buying more affordable. It plans to keep short-term interest rates at record lows through mid-2015. And it's ready to try other stimulative measures if hiring doesn't pick up. November 14, 2012, the Federal signals that it may be preparing to take further steps to stimulate an economy that remains too weak to reduce high unemployment. The minutes of its October policy meeting suggest it might unveil a bond buying program to replace one that expires at year's end.